Good evening, it's Quant Trade Edge, and today I was taking a look at the post-mortem on the gold trade that we posted recently. Did you make 8 times your risk on this trade? This was basically our bread and butter 4x trade, and you know that the way that sets up is when you have a change in trend of the daily trend. So here in gold, this was an up arrow. This was an up arrow. This made a higher high by 4 ticks, and it was a red candle. So that means when we take out the low of that bar, we would wait for a short-term ABC up, hoagie, some sort of setup to then continue in the direction of the daily trend. So this set up last night, and I made a video showing you where this was breaking down, and this was the exact bar that broke down. The 5 p.m. bar was a very long bar, and I mentioned that hoagies, when they are very big bars like this on the breakdown, tend to do an ABC all within the hoagie. And with these, even if you were to barely take out the top of that hoagie with the ABC pattern, it would still be a good pattern to take to the downside. In this case, we only got back up about this far. In fact, I want to say the time we made the video, it was, pretty much getting there, probably 10 or 15 minutes from achieving, well, I guess these are 15-minute bars, so it was 30 minutes away from actually setting up that trigger bar. But basically, this is the 15-minute bar that broke the previous day low. So let's look at this again. Going back to this daily chart, and I'll make it massive so it's clear on the video. What we're doing is waiting for this daily low to be taken out. And, the lazy way to play it would be to just sell short below that low, make some money, stop. But we want to create asymmetry in our trade. So we take that trigger and then apply it, look at a shorter term chart so that we can find a risk bar that is much smaller. And so this is the bar that broke it. And we got this ABC all within the hoagie. And those of you that have watched me for a while know that I don't typically give much merit to anything that happens in a hoagie. So the traditional way to trade this would be to wait until that hoagie breaks down and you have this $11 risk bar, or $12 risk bar. In this case, this $12 risk bar would have still returned over 2R. But what I mentioned, is something that I typically see in natural gas, and that is that an ABC forms within the hoagie. So if you track that ABC within the hoagie, you were able to isolate this risk bar, and this risk bar was only about $4 big. And so a short below 1977 got as low as 1945, and that's $32. So a $32 max win on $4 risk. And you can see that stop was not taken out anytime. So that's how you use the lower time frame in conjunction with the higher time frame to get asymmetry in your risk return. Now, I believe I also mentioned that I don't think this level will get taken out. This level is 1922.30. I believe I even put in a little triangle here, basically documenting what I think will happen here. We'll have a triangle, something like this, and an eventual break higher. And the reason I think that break higher is coming is just a very long-term view of gold. This is a monthly cup and handle. This cup has basically formed over 10 years, and then this handle has been forming over 2 years. And that is just the perfect setup for a really big rally coming in gold. So anyway, I know, it's counterintuitive to play the short side when your long-term view is very bullish. But again, the long-term view doesn't really count for much. At the end of the day, if you can make 4 to 8x your risk day in and day out, the long term doesn't really matter. So anyway, just wanted to fully document the outcome of that trade that we posted earlier. I hope that you paid attention to that and got involved. Let me know if you have any questions, and I will be happy to post answers.